Welcome to News.Markets. It's been a ropey quarter on equity and forex markets, the worst since 2011. Many thought the Fed would tighten monetary policy, which would then, in turn, strengthen the dollar. But the interesting story has been sterling. We're here to talk about where to look for bargains and where to find value in turbulent markets is Paul Rodriguez, technical analyst at Think Trading. Paul, have the markets factored out a move in rates?
Well, I think people are still expecting at some point, either towards the end of the year or to the beginning of next year, that the US and the UK will raise interest rates. But my core view is that deflation and deflationary pressures remain the most compelling element of the markets, and therefore interest rates are unlikely to be raised. In fact, I think there's a potential for lower interest rates, perhaps even negative interest rates. So never say never. So
what does that mean for the markets? Because it's been a dismal quarter, hasn't it, on equity markets in particular?
It has, but you have to also remember that the market's retracing a very long-term upward trend from 2009. So the markets have been rallying for a long time, and now this rally looks like it's coming to the end. So the first stage of that is the markets go sideways, have a retracement, and then potentially have a larger retracement, which is what I think is coming next. So if we are to see another quarter as aggressive as the one that we've just seen, I don't think anyone would be raising interest rates as you know, the market seems to think. Commodity markets are also showing that deflationary pressures are still very much in the fore. All commodities are falling, and it gives no reason from a technical analyst point of view, which is my view, to change my broader outlook for the markets.
In other words, you saw this coming?
Yes, I mean, I've been bearish, to be fair, for some time, and the markets rallied, the equity markets rallied for quite a period of me being bearish. But the key thing is to be looking out for the large retracements, and the large retracements were giving off signals that commodities were falling, and equities took a while before they fell into line, but they fell into line very, very hard, which is always the risk, especially when you're relying on stimulus, external stimulus from the authorities to pump the market higher. And the Chinese situation is absolutely a blueprint for potentially what the market could do. It doesn't always respond to that type of stimulus forever, and when it does, when the market realizes actually this isn't working anymore, you get a very sharp move to the downside, and that's what's happening in the UK and in the US, and therefore the downside potentially isn't over.
So you see potential for a sharper move to the downside. Yeah. What's your time frame?
Well, I think this last quarter could be very volatile. October's a well-known month for market crashes. The crash of 87, 1929, both occurred in October. So I tend to get quite nervous. The market can get very nervous in October. But it's difficult to put a time frame on, because the markets are volatile, and it's contingent on breaking certain levels that induce more selling pressure. So, for example, in the S&P, that's around 1,830 to 40. If it breaks that level, then it opens up a very sharp potential for the downside. With the FTSE, it can stay around the 6,000 level for a little while. It might be a month, might be longer. But if it breaks the August lows, then it opens up 4,500, which is my longer term target.
So what should investors do? Where might they find some bargains, or is it a case of sitting it out and waiting to see what happens in the next quarter?
Well, I think sometimes it's best just to sit the markets out and sit on your cash and keep your powder dry and wait for other opportunities, wait for the markets to fall and then step in, rather than trying to catch. In the markets we say don't catch a falling knife, or don't catch a falling safe. And that's a trader's way of saying, look, when the markets are falling, just wait for it to bottom out, go sideways, and then go back up before you get in. You won't necessarily get the bottom of the market, but you will get a much safer market to buy. So I think either hedging your portfolio with certain instruments that allow you to make money when the markets fall, or literally just sitting in cash and waiting for the markets to fall a bit further before you get in.
So you'll be sitting on your hands before you start rubbing them with glee. Paul Rodriguez from Think Trading, thanks ever so much. It's been a pleasure talking to you.
My pleasure, thank you.